Tech sector rotation into value, just the crash sequence that's about to unfold. There's something happening in the markets right now that looks completely normal on the surface, but contains within it the mathematical seeds of a crash that could devastate unprepared retirement portfolios. It's called sector rotation, and it's been quietly building since late 2025. The rotation isn't dramatic. It's not visible in the headlines the way a stock market crash would be. Instead, it's a gradual shift of trillions of dollars from growth-oriented technology stocks into value sectors like industrials, financials, utilities, and small-cap companies. Money is flowing out of the Magnificent Seven and into overlooked corners of the market. On the surface, this sounds healthy. Diversification is good. Spreading investment capital across multiple sectors is what responsible investors do. But there's a critical distinction between healthy rotation and the late-stage reallocation that precedes major market corrections. And for retirees, understanding that distinction is the difference between a portfolio that recovers and one that becomes depleted before the recovery arrives. Let's start by examining what's actually happening in the data. The Russell 2000 Small Cap Index has just hit an all-time high. In December 2025, it surged 16% in a single month. The index is now at levels never seen before in its entire history. Meanwhile, the NASDAQ 100, dominated by mega-cap technology stocks, has gained only 1.5% in that same period. That's a 1,400 basis point divergence, meaning small-cap stocks are outperforming mega-cap growth by approximately 14 percentage points in a single month. This divergence is extraordinary, and it signals a fundamental shift in how money is being allocated across the market. The data from major financial institutions confirms this rotation is real and accelerating. Goldman Sachs and Morgan Stanley have both been vocal about what they're calling mean reversion, the statistical tendency for overvalued assets to correct downward and undervalued assets to correct upward. Small-cap stocks were trading at roughly a 30% discount to large-cap stocks at the beginning of 2025. As rate cut expectations have grown throughout 2025 and into early 2026, that valuation gap has become increasingly attractive to institutional investors. What was a discount has become a compelling opportunity. The rotation is being justified by legitimate fundamental considerations. Small cap earnings are projected to grow 22% in 2026 versus 15% for large cap earnings. Smaller companies benefit more directly from lower interest rates because they typically carry more debt and face higher borrowing costs. The math is sound. But here's where the warning signal becomes critical. Rotations that appear justified by fundamentals often mask the underlying instability that's driving them. The reason institutions are rotating out of mega-cap tech isn't purely because small-cap valuations are attractive, it's because mega-cap tech valuations have become extreme enough to worry even the most bullish investors. The Magnificent Seven are trading at 28 to 40 times earnings. Apple is at 32x, Microsoft is at 35x, Nvidia is at 40x. These aren't moderate valuations, they're valuations that incorporate decades of perfect execution and consistent growth. And when valuations are that extended, even modest disappointments trigger sharp repricing. The rotation started as a trickle in October 2025, accelerated into a stream in November 2025, and has become a torrent in December 2025 and January 2026. Institutional money is clearly rotating with urgency, but here's where it becomes dangerous. The rotation itself is creating the conditions for a crash. To understand why, you need to understand the mechanics of how index funds and passive investments work in highly concentrated markets. The S&P 500 is a market capitalization weighted index. The Magnificent Seven represent approximately 34 to 37% of the index. When you own an S&P 500 index fund, you're accepting that roughly one-third of your portfolio is concentrated in 7 companies. As long as those companies are doing well and attracting money, the concentration isn't problematic. But when institutions begin rotating out of those companies, the mathematics become sinister. Here's why. When mega-cap tech stocks decline, they become a smaller portion of the index. Index funds, which are designed to maintain the weighting of the index, must rebalance to maintain those proportions. When a stock declines 20%, it becomes underweight in the index. To rebalance, the index fund theoretically needs to buy more of that stock to bring it back to its target weight. But that's not what happens during rotations. Instead, what happens is that the other money in the fund, money in non-mega cap stocks, becomes relatively overweight. To maintain index proportions, the fund needs to sell the non-mega cap stocks and buy the declining mega cap stocks, but that buying doesn't prevent further decline in mega cap stocks. Momentum is gone, the smart money has already left, so the index fund is essentially buying into a falling knife while simultaneously selling the assets that have momentum. This creates a mechanical constraint on how much capital can exit megacap tech before forced selling creates a cascade. Imagine a scenario where institutional investors want to rotate $1 trillion out of megacap tech over the next 12 months. That trillion flows into small cap stocks, value stocks, international stocks, and bonds. As that trillion flows in, those asset classes appreciate. Small cap stocks rise 20%, bank stocks rise 15%. This rotation works fine as long as the mega cap tech money is exiting methodically. But what happens when market participants realize that the Magnificent Seven's earnings growth is slowing? What happens when Q1 2026 earnings come in with disappointing profit margins due to capex spending? What happens when the narrative about sustainable AI spending shifts to concerns about actual monetization? That's when the rotation accelerates into a stampede. The trickle of money leaving becomes a flood. Institutional investors who had been rotating gradually become concerned that the megacap tech decline might be steeper than they anticipated. Instead of exiting gradually over 12 months, they accelerate their exit. They try to exit over 3 to 6 months. The supply of megacap tech stocks for sale increases dramatically. The demand for those stocks doesn't. Price falls sharply. This is where the cascade begins. Once mega-cap tech stocks start falling sharply, investors holding S&P 500 index funds suddenly realize their portfolio has been extremely concentrated in exactly the stocks that are declining most sharply. They panic. They call their advisors. They ask questions they should have asked years ago. Why is my diversified index fund doing so badly when the rest of the market is doing fine? The answer, of course, is that their index fund isn't diversified, not really. 34 to 37% of it is concentrated in 7 stocks that are all correlated, but that panic accelerates redemptions of S&P 500 index funds. When those funds are redeemed, they must sell stocks to raise cash. They sell the stocks they hold in the correct index proportions, but the Magnificent Seven have become a much smaller portion of the index now because their prices have declined, so the fund is selling everything to raise cash, including small cap stocks and value stocks that haven't declined. This selling pressure on the non-mega-cap portion of the market, combined with the concerns that triggered the initial rotation, creates a vicious cycle. The Russell 2000 that was at all-time highs suddenly starts declining. Bank stocks that were surging start to correct. Industrial stocks that were up 20% start to give back gains. The rotation reverses into forced selling across multiple asset classes simultaneously. This is a crash sequence. Historical precedent provides striking parallels. In 2000, the concentration in technology stocks reached about 30% of the S&P 500 at peak levels, actually lower than today's 34 to 37% concentration. The rotation into value stocks began in late 1999 and early 2000. It looked reasonable. Investors were moving out of stretched valuations into bargain-priced value stocks, but as tech continued to roll over and the rotation accelerated, a feedback loop developed. By October 2002, the Nasdaq had fallen 76% and the S&P 500 had fallen 49%. The key point, the rotation didn't cause the crash directly, but the rotation was the early warning signal that investors were recognizing the valuations were unjustifiable. Once that recognition became widespread, the crash followed. We're in the early stages of that same sequence right now. The rotation is happening. It appears justified. Small cap earnings growth is genuinely expected to outpace large cap growth. Lower rates genuinely do help small cap companies more than large cap companies. The rotation is mathematically sensible given current valuations and rate expectations, but the rotation is also a signal that institutional investors, the people managing massive amounts of money on behalf of pension funds, insurance companies, and endowments, are losing confidence in mega-cap tech valuations. They're moving money before the market reprices, they're front-running the repricing, and once that front-running converts into stampede mode, the repricing will be severe. For a retiree, the specific danger lies in the timing and the mechanics. If you own an S&P 500 index fund and the Magnificent Seven decline 30% while the rest of the market declines 10%, your portfolio has declined approximately 15%. 34% times 30% equals 10.2% plus 66% times 10% equals 6.6% for a combined 16.8% approximately. That's recoverable. But that's not what historical precedent suggests happens. When mega-cap concentration reaches these levels and rotations accelerate, the broader market follows downward. In the 2000 example, a 30% concentration in tech didn't lead to only a 15% S&P 500 decline. It led to a 49% decline. The math suggests that tech's steeper decline, $3 trillion in market cap losses, forced selling in other areas that multiplied the overall impact. The mechanics are instructive. When mega-cap tech falls 30%, Roughly $3 trillion in market capitalization is destroyed. Pension funds holding that $3 trillion suddenly have depleted portfolios. To maintain their required allocations to different asset classes, they must sell other stocks to rebalance. They sell small cap stocks, they sell value stocks, they sell industrials. This forced selling applies downward pressure to everything. Simultaneously, individual investors holding index funds panic and redeem those funds. Index funds must sell stocks to raise the cash to meet redemptions. They sell in index proportions, meaning they're selling small cap stocks too, even though those stocks haven't declined as sharply. The demand-supply imbalance for all stocks becomes unbalanced. Everyone is trying to sell. Nobody wants to buy. Prices fall. The crash sequence works like this. First, mega-cap tech valuations compress as earnings growth disappoints and the market reprices down from 35x earnings to 25x earnings. That's a 29% decline for no fundamental reason, just valuation normalization. Second, investors recognize that 25x earnings might still be too high for growth companies facing capex burdens and margin pressures. Repricing accelerates from 35x down to 20x or 18x. That's a 43 to 49% decline. Third, panic selling begins as institutional investors rush to exit before prices fall further. Repricing becomes chaotic, falling to 15x or lower as forced sellers meet no buyers. That's a 57 to 57% decline from the peak. Fourth, the rotation amplifies into forced selling of non-megacap stocks as institutional rebalancing creates supply-demand imbalances. The small-cap surge reverses into losses. Fifth, recession fears spread as investors recognize that the collapse in tech valuations signals weakness in economic fundamentals. The entire market enters bear market territory. That five-step sequence is not hypothetical. It's the pattern that occurred in 2000-2002. It occurred in 2008-2009. It occurred in 2020, though accelerated and cushioned by massive stimulus. The mechanics are consistent. Rotation begins. Rotation accelerates. Panic emerges. Forced selling creates cascade effects. Recession is recognized and markets discount it. The crash completes. What's remarkable about 2026 is that several of these conditions are already in place. Megacap tech concentration is at extreme levels. Earnings growth is decelerating, particularly when accounting for capex burdens. Valuations are extreme at 28 to 40 times earnings. The rotation has already begun. What hasn't happened yet is the recognition that earnings might disappoint more than currently expected. That recognition will arrive with Q1 2026 earnings in late April and May. When companies report strong revenue growth paired with disappointing margin compression due to capex spending, the narrative about mega-cap tech growth will shift. That shift will accelerate the rotation into a stampede. For someone in retirement, this creates an urgent planning scenario. You have approximately 12 to 16 weeks before Q1 2026 earnings arrive. During those weeks, the rotation is likely to continue but not accelerate dramatically. The market will interpret the rotation as healthy broadening of leadership. Valuations will continue to appear reasonable because the full implications of margin compression won't be visible until earnings are reported. This is the window to rebalance. This is when you can reduce your concentration in mega-cap growth without doing so at depressed prices. This is when you can shift allocations to more defensive positioning while there's still time to do it rationally rather than doing it in panic mode. The specific rebalancing steps deserve consideration. First, audit your actual concentration. If you own an S&P 500 index fund, calculate how much of your equity portfolio is in that fund. If that fund represents 50% of your equity allocation, then 17 to 19% of your equity is concentrated in the Magnificent Seven. That's extreme for a retirement portfolio. Second, consider splitting S&P 500 exposure between market cap weighted and equal weighted versions. Equal weighted versions distribute capital equally across all 500 companies, eliminating concentration risk. A 50-50 split between market cap and equal weight reduces mega cap concentration dramatically. Third, reduce overall equity exposure if you're in your 60s or beyond. If you're drawing 4% from a portfolio and that portfolio is 70 to 80% equities, you have too much risk concentrated in exactly the area most likely to decline in coming months. Fourth, build cash and bond reserves. If a crash sequence unfolds over the next 12 to 18 months, you want 18 to 24 months of living expenses in cash and short-term bonds. This buffer allows you to avoid forced selling of stocks at depressed prices. It allows you to wait out the crash and then rebalance once valuations have normalized. Fifth, understand that this rotation could be the beginning of a long-term shift in market leadership. The era of megacap tech dominance might be ending. A more diversified market leadership structure might be emerging. That's not a problem for equity returns long term. It might actually be healthy, but it means the 7 to 10% annual S&P 500 returns that characterize 2022-2025 might not repeat if leadership is genuinely broadening. Sixth, stress test your withdrawal rate under various scenarios. If the S&P 500 declines 40% and your portfolio is 60% equities, you've experienced a 24% portfolio decline. Can your 4% withdrawal rate still be sustained from a 24% smaller portfolio? If the answer is no, reduce your withdrawal rate now while the portfolio is larger. Seventh, consider adding non-correlated assets. International stocks, commodities, and real estate don't move in lockstep with domestic equities. They can provide diversification benefits during rotations and crashes. The rotation into value will likely continue. Small cap stocks might continue to outperform for several quarters. The Russell 2000 might reach even higher levels before the crash arrives. That continued outperformance doesn't mean the rotation is healthy. It means the rotation is continuing as it should before the acceleration phase. The crash doesn't begin the moment the rotation starts. It begins the moment the rotation accelerates beyond what fundamentals can justify and forces selling emerges from portfolio rebalancing dynamics. For a retiree watching this unfold, the key insight is recognizing that this rotation is a warning signal, not a bullish indicator. Historically, sector rotations precede crashes. The rotation out of tech in 2000 preceded the NASDAQ crash. The rotation that occurred before 2008 preceded the financial crisis. The rotation happening now is signaling that sophisticated investors see danger in megacap tech valuations and are moving to safety. That usually doesn't end well for investors who wait for the crash to begin before repositioning their portfolios. The mathematics of concentration are immutable. 34 to 37% of the S&P 500 is 7 stocks. When those stocks decline significantly, the cascade effects ensure the broader market declines more than the simple math would suggest. A 30% decline in the Magnificent Seven, combined with forced selling and forced rebalancing, translates into a 35 to 45% decline in the broader market. That's not speculation. It's the pattern that occurs when concentration reaches these levels and rotations accelerate into stampedes. Your retirement portfolio's resilience depends on how much of that decline it absorbs. If you've reduced concentration, added defensive positioning, and built cash reserves, a 40% market decline is manageable. Your portfolio declines 20 to 25%. Your cash reserves cover 18 to 24 months of living expenses. You wait out the recovery without forced selling at depressed prices. You emerge intact on the other side. But if you've maintained megacap tech concentration and are drawing 4% from a portfolio that declines 40%, you face sequence of returns risk that's very difficult to recover from. You're forced to sell stocks at precisely the moment when they're most depressed. You've locked in losses that become permanent portfolio depletion. The rotation is happening now. The crash sequence that follows it is probable within the next 12 to 18 months. The time to rebalance is before the crash begins, not after. The window is open right now. It won't remain open forever.